Welcome to the Capital Edge by MK, where the deals are decoded and market makes sense. Today we have with us Mr. Yatin Singh, a seasoned investment banker and head of our IB team, who has had front row seat to frenzy in India's capital market. So let's get straight to it. Welcome, Yatin.
Hi, Prachi. Good morning.
Hi, good morning. Let's begin with the IPO buzz. The primary markets are on fire again. What's your take on what's fueling the surge?
So, they were on fire till about October last year as well. I think what dampened the sentiment was global uncertainty around trade flows, which was largely a function of the change in political dispensation in the White House. That seems to have abated. I think the general perception is that these trade-related issues will sort themselves out. It is expected that India will get some sort of an interim deal before July 9th, and then by October we may have some sort of a bilateral trade agreement with the US. We've shown some progress. We've signed an agreement with the UK, and many more are in the works, including the big one at EU. So I think the volatility or the perception of uncertainty which had disrupted markets and led to a reduction in both interest in both secondary and primary markets, that seems to have reversed now. So we are back to where we were. I know the way I look at it, there is no real spike. It is going back to the normal as it was in the first half of 2024.
Okay, so everybody is taking it from where they had stopped or they had paused it.
Yes, paused, or at least the recovery in sentiment is to the levels where it was.
Correct. So how different does the IPO cycle feel from, say, what we saw in 2021? Are companies better prepared this time around?
I'd say it's about the same. For the simple reason that we've been at it for 2-3 years now. So learnings, if any, have been absorbed and have been incorporated by most companies who are looking to go public. And of course, there is incremental improvement every day, every month.
You learn from others' mistakes.
Yes, you do. From mistakes and their successes as well.
Correct.
And I think that's happening. That's happening incrementally. Has there been a drastic shift? Nothing that I could feel in perceptible terms, but then again, that this is based on my experiences. Maybe, there is some improvement.
You also keep evolving with other companies. So.
Exactly. Absolutely.
Correct. So let's talk about manufacturing. With IPOs from capital goods and infra companies doing well, do you see this as structural shift or a short-term macro play?
No, it's a structural shift. It's a structural shift and it emanates from policy to economics and geopolitics to actual improvement in business sentiment and business realities pertaining to this space, right? So we don't have too many manufacturing companies in the large cap space.
Correct.
If we have to gain some sort of salience in this restructuring of global supply chains, then that has to change. Also, if we have to create gainful employment for this large workforce, which our demography is throwing up every year, then again we need manufacturing to be bigger than what it is. That growth will need capital. Some of it will be funded by banks. The balance will get funded, through capital markets.
Right.
So I think this is structural. Cap goods and infra within the larger manufacturing or whatever the industrials cohort is doing even better because some of it is funded by government spends, which are needing the private sector, in terms of investments for the last few years. But hopefully this will sustain because private sector is starting to invest. We are seeing those green shoots for a while.
Make in India is working.
Make in India is working. We also have, a general resurgence of, a lot of unorganized manufacturers moving into the, organized space and accessing capital to grow, which wasn't the case. Now, why? Some of it is because of the demand dynamics. A lot of it is also with structural policy changes like GST, which incentivizes becoming organized, right? So once you do, then you realize that, okay, there is access to cheaper banking finance, and also there is access to, public markets for growth capital, right? And that's what companies are doing.
Money which rewards transparency.
Yeah, in a way it does.
Okay. Which subsectors within the manufacturing space do you think are ripe for listing over the next 6 to 12 months?
So many, but if one were to take, what has changed very recently, I think it's just that the volatility in the world is definitely leading to increased defense spends across the world. Japan is remilitarizing, so is Germany. In the recent NATO summit, they have, agreed to increase their defense spend to 5%, right? Now that these are all substantial amounts of monies which will flow to the defense industry. India may not really have an immediate benefit in the selling the entire system kind of opportunities, but a lot of components and sub-assemblies and parts of the value chain which go into the final system, that is where there is a big opportunity for Indian companies. And you see a lot of companies who used to be in auto or other industrial space moving to the defense adjacency, and building reasonable order books already, and this will only grow because we are at the start of it, right? So any manufacturing company which has a existing or capability to manufacture something that goes into defense consumption is an obvious new segment of companies who would benefit out of this whole recent change in the world. Apart from that, the China plus one thesis is playing itself out for many years. Reshoring, friendshoring, some of it has gotten diluted because of change in government in America, but structurally and thematically, these trends will continue, and India will hopefully benefit from it, at least partially. And to that extent, generic prospects for manufacturing and manufacturing related businesses are good, and hence many of them will continue to find favor in capital markets.
Correct. And India being the next consumption economy, I hope that will also play out.
So that itself also will play out. Though I think, that has been a case historically as well. So the incremental effect of it may still not be as much as these other, trends and changes which are outside our borders.
Are promoters in these sectors thinking about IPOs earlier now thanks to policy tailwinds like PLI?
Yes, of course, yes, because with the buoyancy of markets and healthy flows on the supply side through SIPs, I think public markets are very receptive to new ideas, and that is reflected in the volume of deals.
Correct.
So obviously some of these companies who need capital will explore public markets as an option, and we would see that in near future for sure.
Of course, and public markets are always in search of next big ideas. So
they are. With the supplies being where they are, there's only so much secondary markets can absorb, right?
Correct.
So this money needs fresh paper, and we are in that very ideal situation where both demand and supply of capital is very healthy.
Perfect. So, are we seeing more domestic institutions drive the action this time, or are foreign flows still in play?
So, domestic for a while, I think post COVID, the salience of domestic institutions has kept increasing, which is thanks to the SIP flows. Right? And in today's environment, I think the dependence on foreign investors for small to mid-sized IPOs is very limited. It's the larger ones like HDB, like Hyundai, like Ather or Ola, or those kinds where you still need healthy foreign participation for success. But for more small and mid-sized IPOs, I think there is enough available domestically.
Correct. How are the global risk factors like US interest rate uncertainty affecting the primary market mood in India?
So anything which has a negative effect on global demand will definitely, have second order or third order effects on the order books of Indian exporters. Right? So to that extent, there is some effect. However, we have as a country managed to, kind of stand on our ground much better than a lot of other, economies of our kind of development levels. A lot of it is also given to the fact that our external linkages were limited to begin with. We are trying to now grow our export pie, but we've largely been a domestic consumption-based economy and government spending-based economy, and that has helped withstand the current turbulence that many other Asian countries are experiencing.
Right. Beyond manufacturing, we have seen digital first and SaaS companies re-entering the IPO discussion. Is the market ready for another round of tech listings?
They are. But I think there are learnings as well. So not all the new age businesses who listed have delivered on shareholders' expectations. Some of it is a function of the fact that these business models themselves are very rapidly evolving, and certain assumptions at the time of IPO investments may not play themselves out as it was originally assumed, right? So things are fairly dynamic there. But that said, I think investors believe that we are in a rapidly changing world. New business models will disrupt existing business models. It's just a question of timing and profitability. I think SaaS has a much better, profitability quotient than say the consumer-facing new age businesses, right? And those definitely will be welcomed. But even a consumer-facing, new age business, we've heard about Misho now looking to do a large IPO.
Correct.
Cure Foods has filed for its IPO. So many of the Wakefit has filed for its IPO. So many of the consumer tech, fintech, D2C brands, all these new age business models on the consumption side will look at public markets, and there will be, depending on a case to case basis, decent interest as well.
Of course. And of course, you have to create value for your consumers before you go to investors. So
Absolutely.
All the stocks which will find
are doing well. So of the ones which got listed, if you see the ones who have done better than the others, it's largely because they have maintained their value proposition for their consumers, which is translated in growth and improving business economics, and which translates into improved profitability. Now, that improvement may not be absolute profits, but at least the quantum of losses has to consistently reduce, so that the roadmap to profitability is that much more believable.
Makes sense. Green energy and EV infrastructure seem to be gaining traction. Are you seeing any credible IPO candidates from that space?
So there are many. Particularly for renewables, because of the whole value chain getting built from scratch. There are investment opportunities. There are IPOs, across the value chain, from developers to manufacturers to component manufacturers and the works, EPC companies and financiers. So it's not just IPOs, the QIP space as well. Emkay itself was a part of the IREDA QIP, which is a large renewables financier, right? So the entire opportunity is so large that it will throw up many IPO and QIP opportunities for investors. On the EV side, I think things are a little in flux, in my opinion, simply because India at least has not figured out who will be the winners. Will it be the challengers or will it be the incumbents, both in the two-wheeler and four-wheeler space,
right,
who will eventually, take up large market share? Particularly in the two-wheeler space, the turbulence is more because you have the EV first companies like Ather and Ola, and then you have the incumbents, the big
TVS has done amazing.
Absolutely, right? So they are not giving up. Indian entrepreneurs don't give up very easily, right? So they are going to give these new age businesses a fight for their money.
Right.
this is not a winner takes all market,
Yeah.
right? So there could be an outcome where everyone can coexist profitably with a certain market share. India is a large market, particularly for two-wheelers. In the four-wheeler space, we never had a digital first equivalent like BYD or Tesla.
Right.
But I think Tata and Mahindra have done reasonably well, and even in the luxury four-wheeler space, it's very early days. But it's the incumbents, the Mercs, the BMWs, who are actually seeing some traction in terms of actual sales.
And we don't really have the charging infrastructure to go full-fledged EV.
Absolutely, right. So which is why my take that the EV space is slightly different from the renewable space.
Correct.
There the thesis is very, very, very sound. In the EV side, again it's a ecosystem getting built from scratch. But we've not really been able to see many successes, at least in the component or the the sub-assembly space. My take is that even there, it is existing manufacturing companies who are in some adjacencies who will see this as an opportunity and get into it. And they're already doing, many of them, right, including many listed autocom companies who are already, now seeing their order book composition shift from, combustion-based engine platforms to EV platforms. So that's happening incrementally, but yeah, not to the scale as the renewable space.
Any sectors flying under the radar today that you think could surprise us on the bourses in the next year or two?
Nothing is flying under the radar. In a rising tide, all boats move up. But I'd say that lending as a space has not seen as much activity, as some of the other parts of the economy. So I think lending, and within lending, I think NBFCs actually have been not very active. We see a lot of IPOs and QIPs from the NBFC space because as the interest rate reduction gets transmitted through the economy, borrowing costs will come down. And our understanding is that this has been done at a policy level to boost consumption, also boost investments, but primarily to boost consumption. When overlaid with some other fiscal measures like reduction in tax outgo for working class people, which happened in the budget, all of which will translate into larger retail, borrowings. I think there NBFCs stand, an operational advantage over many banks. Given that they are geared for unsecured or retail kind of lending models, and to that extent we see healthy prospects for NBFCs, and we may be surprised in terms of NBFC fundraise through IPOs and QIPs, not just IPOs but QIPs as well.
Any of these new age tech lenders you think could be disruptors to this NBFC lending space?
At this stage, it's hard to say because, like EVs, in the lending space, the incumbents, the banks, are not, giving up. Also, lending is far more regulated than many other sectors of the economy, right? And we have a regulator who has a very balanced approach between innovation and risk management.
Correct.
And many of these new age companies, their business models, they fall short on RBI expectations. Of course, there are models like Paytm, which are already listed where lending is one of the components of the business thesis. But for pure play, digital first lending business to list in near future, yes, there may be some, not a lot. I don't think too many of them are at a level where investors' perception on regulatory risks will be abated by the current realities of where those businesses are.
Which recent deal or IPO structuring stood out for you, either for creativity or boldness?
There is very limited creativity that one can do in IPOs because this is a very, very, very templatized regulatory framework that everyone is supposed to operate under. So I don't think any creativity on the structure side is something that stands out. But yeah, I'd say what we saw with HDB recently, that's fairly bold because, here is a company who has its shares being traded in the unlisted market at a certain reference price, but they were bold enough to acknowledge the fact that if one has to IPO in the current market, the valuation of expectations of institutional investors may be different, particularly given the size. And they took almost a 40% haircut to the perceived value from those unlisted trades. I think that's bold in my opinion, right? The boldness is not just going overboard and
marketing
and doing fairly aggressive stuff. It also means acknowledging the market realities to achieve your objectives, right? Which is something that doesn't happen very often in India. Maybe what helped HDB is that it's not a promoter-owned company. It's owned by HDFC Bank, which itself is a professionally managed institution. So it's easier to take some of these decisions, but that should not take away anything from the fact that the management did a fairly bold call of changing the pricing in sync with where the market is.
No, but point taken. Because it was not a promoter-led company, probably a lot of decisions were not emotional driven.
Yeah, they were institutional.
They were logical. And they were logical because in a lot of these IPOs, the promoter feels that this should be the fair value, and
so the sentiment, the individual sentiment sometimes overrides obvious logic, right? Which wasn't the case here. And that should be acknowledged.
Yes.
We have seen a few promoters opt for pre-IPO placements. Is that becoming a norm now, or is it too? Sorry.
I Gupta. We have seen a few promoters opt for pre-IPO placements. Is that becoming a new norm to manage post-listing volatility?
I don't think there is any significant correlation between pre-IPO and post-listing volatility. Yes, we have seen a few companies doing pre-IPOs and more than what used to be the case earlier. I think it should be used judiciously. If a company really needs growth capital and cannot wait it out for the IPO monies to accrue to its accounts, then you should definitely raise capital. There is no legal definition of pre-IPO in India. That's just a commercial jargon. It's just a private placement, right? It has its pros and cons, and every management team should evaluate it before jumping into this fundraising route. It doesn't necessarily have any impact on the post-IPO outcomes. It does create a pricing reference for the IPO, and to that extent, companies and their management should be careful and judicious in how much they're raising and at what value. Because there's certainly this is the last reference before the IPO in terms of pricing and valuation, and that does come into play.
Correct. So SEBI has been pretty active, from tightening disclosure norms to regulating influencers. Are these changes helping or hurting the market confidence?
I think in the long term they will help. They certainly will help because regulations need to keep pace with the evolution of the market, and given the strong SIP flows, our primary markets are growing rapidly. In the short term, any change in regulation can create turbulence, right? So to that extent, it may not be welcomed by those who are at the receiving end of any change in policy or any norm. But in the long term, I think the regulator has only the overall health and well-being of capital markets in mind. And we should be happy that we have a dynamic regulator for capital markets, who's trying to make sure that there is a healthy growth in the market without any kind of obvious risks or anything that can be otherwise managed through policy.
Yeah.
So I take this as a big positive.
Yes, they are very big on investor protection, and I, for one, welcome this because
Absolutely.
we all
We all
are
do.
investors
We
as
all
well
do.
in our own capacity.
We all
So,
do. Even as merchant bankers, we all do.
yeah. What do you make of SEBI's push for easier SME listings and faster clearances? Is it working on the ground?
It seems to be. So the SME space is, very opaque. And the opaqueness is, largely on account of the fact that price discovery in the SME market as opposed to main board is not driven by, institutions. It is basically, non-institutional investors of varying degree of capability in terms of net worth who participate in that market. Companies are smaller. There is anyways an inherent risk in such business models, but also the fact that the liquidity in this market is very limited, and that makes it vulnerable to a lot of manipulation, and hence the regulator needs to be even more hands-on as far as the policy and the overall risk management of this market goes. I think to that extent, like the main board, whatever they're doing here should be welcomed. Some of it may create immediate outcomes for companies which were exploring a listing near term. But for overall health of the market, I think this is again a very welcome move.
Perfect. So, how are companies adapting to ESG norms, especially those gearing up for IPOs?
Look, I think ESG, of course, it's relevant. Not so much in India, if I can be a little, honest about it. Yeah, not a very nice thing to hear, but simply because most of the companies who IPO in India, they are still fairly growth focused. Most Indian companies who IPO are still promoter owned, promoter driven, and a promoter at any stage will have a whole spectrum of considerations. I think growth will definitely be a higher consideration than some of the other things. Not that no one people want to ignore ESG considerations or they're oblivious to it. Of course, everyone wants
Other
to do right.
concerns might take priority.
Yeah, so other concerns take right. Where I think ESG is becoming more relevant is from a policy standpoint, right? So, if policy supports investments in renewables, then that as a business opportunity, not because of ESG reasons, but for sheer commercial and financial reasons, has become big. Right? We spoke about EVs as well. Again, something similar. I think within the ESG, the governance part is something that is rapidly improving, because some of it is because of policy. Stock exchanges, the regulator, SEBI, have been at the forefront of driving this change. Yes, companies are promoter-owned, promoter-driven, but the second layer of management now is a lot more professional and competent than it used to be 20 years ago when I started my career. So that's a welcome change, right? So yes, it's happening, but is it an overriding consideration for companies in India? Not at this stage, no.
And as you mentioned, if policy changes, like for example, toxic waste disposal, and if a company has something related to that, they have to comply with it, right?
They will. So it's policy driven. Not if it is policy driven.
Yes.
Yeah. Probably it will be for foreseeable future.
That's right. What's one piece of advice you would give to a promoter who has never raised institutional capital before?
Don't rush into it. I mean, generally that should be the principle in life. Don't rush into something that is a really big decision. Be prepared, understand what it entails. Like life, capital raising is also about managing, your relationship with investors, being aware of their expectations, trying to live up to those, having transparent communication all the time. For companies who have not raised institutional capital, that's a significant change in both mindset and as well as the kind of the day-to-day operations of the company. And promoters should allow themselves the time to be able to recalibrate their own existence, right? From what it was when it was a pure family-driven entrepreneurial venture to now when you want to open up to institutional participation.
Lot more accountability and oversight.
Accountability, transparency, communication, living up to expectations, which means risk management, approach to risk. All of that has to recalibrate. And it starts at the top with the promoter himself, right? And so he has to give himself time to do it and be fully convinced that he is doing this not because markets are good. Touch wood, Indian markets will continue to be good for foreseeable future. So yes, there may be certain periods, few months where, because for external reasons, the deal activity may subside, but by and large, if you look at a 3, 4, 5 year horizon, there will be enough opportunities to go public and raise institutional capital. Don't let the mad rush drive decision making. Don't let the tail wag the dog. Be prepared, be confident, and be honest to yourself that you're ready to pivot to this changed existence, which would be when you are a promoter of a public company. And once you're mentally, confident that you're ready for it, of course, then you should take the plunge.
You're ready to welcome other bosses into your life.
Bosses, partners, whatever you call it. But yes, there is someone other than you who matters now.
To whom you're answerable.
You are accountable to them.
Correct. Indeed, an insightful session today, Yatin. Thank you very much. Thank you for watching, everyone. For more exciting action, do join us again and watch, like, share, subscribe. Until then, stay bullish.
Thank you, Praj.
Thanks.